Bang! Hey gang, I'm Dr. Who. This is Accounting is a Joke, where accounting makes sense so you can make dollars. Today we're going to take a look at a walkthrough problem of how to properly record a collection on an account outside of discount terms. So if you're unfamiliar with discount terms, don't fret gang, I dropped a link to get you up to speed in no time. With that being said, let's get it. So it tells us to journalize the following sales transactions for Henry's Craft Shop. Explanations are not required. Then we have some information here for Henry. Okay. And then it tells us journalize the sales transactions. Gotcha. All right, gang. So we are dealing with inventory. And a quick recap on inventory. From a merchandising company's perspective, there are always two sides of inventory that you must be able to recognize. The selling side of inventory and the purchasing side of inventory. In this particular problem, we are identifying how to collect on our account outside of the sales discount terms. Now, discounts are simply given to customers to entice them to pay quicker on their accounts. Thus, if they pay within a certain time frame based upon the discount terms, they'll get a discount on the amount that they actually owe. Sometimes companies will net the discounted amount to the initial sale transaction. Sometimes companies won't. But in this particular problem, the companies are, which means that the initial sales amount will have the netted discount from the sales price. And so with that being said, if the customer pays outside the discount terms, thus not truly utilizing the discount available, then the company must recognize an account called Sales Discount Fortified. Sales Discount Fortified is an other income amount, thus being reported on the income statement, that increases the amount of revenue that was actually earned to the initial sale. Remember gang, initially the company assumed that the customer was going to take advantage of the discount, thus reducing the sales revenue. Therefore, if the customer refuses to receive the discount given by paying outside the discount terms, we must recognize more revenues from the initial sales. So with that being said, let's take a look at the problem. So it says that Henry sold $4,000 of craft supplies on account credit terms 210 net 30 to Quick Quilts. Cost of goods sold is $1,200, and they want us to record the sale. So we already know the deal, gang. We have two separate transactions that we must account for after every sale. One to account for revenue and the other to account for cost of goods sold. However, when it's time to account for our revenue, gang, we are going to assume that the customer is going to take advantage of the discount. And what is the discount? Well, based upon these 210 net 30 discount terms, it simply means that we're going to give the customer a 2% discount if they pay within 10 days after the third, or they have to pay the entire net amount within 30 days. Therefore, to calculate the appropriate discount amount, we take 2% and we multiply it times 4,000, which gives us $80. Now, we're going to assume as the company that the customers are going to take advantage of this discount, which means we're going to net that amount to the initial recording. So we're going to debit accounts receivable and credit sales revenue for the total amount of $4,000 minus 80, which will give us $39.20. We're going to check the answer. Beautiful work, gang. But we're not finished. We have to record the cost of goods sold for selling the inventory. Therefore, we're going to debit cost of goods sold and credit merchandise inventory at cost of $1,200. We're going to check the answer. Excellent job. Now, February 23rd tells us that Henry received payment from Quick Quilts on the amount due. So here's the deal, gang. It is now February 23rd, and this is considered a collection on the account. But one thing we must consider is the dates involved. Remember, our initial sale transaction occurred on February 3rd. It is now the 23rd. So one thing we have to address is whether or not a discount is involved. And obviously we know it's not. It is without the discount. The customers had 10 days after the 3rd to pay in order to receive that 2% discount. And as we can see, it is beyond the 10 days. It is now February 23rd, which means that they're not receiving a discount. But it also means that since we recorded initially, assuming that the discount was going to be given, we have to increase our revenue. And we're going to do it through an account called Sales Discount Fortified, which belongs on the income statement as an other income amount. Therefore, we're going to debit cash for the entire amount of the initial product, which was $4,000. We're going to remove accounts receivable off the books for the net amount of $39.20. And as we can see, again, our debits and credits aren't equal, and this is where we're going to credit Sales Discount Fortified for the $80. We're going to check our answer. Bags all day. So there you have it, gang. A quick, easy illustration of how to account for collections on accounts outside the discount terms. So if that light bulb clicked after watching this video, please like, subscribe, and share the channel with your friends so they can chase the bags as well. As always, gang, I'm Dr. Who, and I love the time and energy that you guys share with me, and I'll see you soon. Bags!